What's up YouTube, it's Todd Horst here with Tasty Tracker, and today I'm going to do a video on leaps and why I hate them. I'm using the external mic instead of the headset. I've been getting a lot of dips in the audio, so hopefully this one is better. So first up, what I'm going to cover, I'm going to cover entering and exiting, what a poor man's covered call is as that relates to leaps, sort of the risk involved with these and who it makes sense for, why I personally hate them, and then recommendations and conclusions. So just getting started, you'll want to watch my 16th video, Options 101, to get a background on buying calls to open, what are calls, etc. If you watch this video before you watch that one, you're going to sort of probably be lost in terminology. So leaps are simply long calls, and again, long just means that we're purchasing calls. It doesn't necessarily mean that you want the stock to go up, because long can be associated with puts. You can have long puts, and that would mean that you want the stock to go down, that you bought those puts. So leaps, again, are most commonly long calls that are a year or more out. Just like penny stocks, people often get hung up on what exactly a year or more or less. They get caught up on those days to expirations instead of just thinking about it being something with a long expiration. So I don't get hung up on that. Don't be one of those people. Just understand that it's something. I typically think of anything 6 months or longer as being a leap, because most people that are gambling with options are going to be doing something on this expiration, or this week's expiration, or next week's expiration. So just by saying 6 months out automatically puts you in the other category where you're playing more conservative with your options. Typically people are buying leaps at around an 80 delta, and I'll show you that in Tastyworks, not Thinkorswim, sorry, how to set that up. But they're typically doing that at 80 delta, which means it's deep in the money. The reason they're doing that is to help ensure that when expiration time comes, if they were to happen to hold it the whole way through expiration, that there would still be value to that option. So in other words, they don't want to buy this option and then in a year have it be worthless. Obviously that would stink, because they're going to be spending a lot of money to get an option that's a year away in expiration. Of course, getting a higher delta means they'll be spending even more money, but there's more insurance there that it's going to be worth value. So here are two screenshots of Tastyworks. So I selected Apple. I went out to January of 2022, which we can see here is 517 days. I clicked on the ask here, 161 on the 370 strike, which means I want Apple stock to be above 370. We can see that right now Apple is trading around 500. I just took this screenshot today. So I had to scroll up in the options chain in order to get to this far, this deep in the money. And you can see here I selected the delta column as my optional column to display. And again, I selected, you could obviously have chosen 370 or 380. But there's not that much of a difference here, $500 difference, I guess, between these two, and then this gives you $10 more to be right. So we can see here the cost for that is $161 per share. So because each contract is times 100 shares, we take 161 times 100, and that gives us the $16,000 debit that we will pay in order to buy this contract. Our maximum profit here is infinity, because Apple could go to the moon. And so there's no way to judge how much this is going to be worth, at least from a max P&L kind of method, to say what this is going to be worth in a year's time if nobody can predict where Apple's going to go. I'm just going to leave it there. So we can see the buying power is reduced by 16,000, obviously, plus commissions. Let's move on. So entering, the whole concept is this is one leg, which is very, very simple to do. And so you know right away what your max loss is because you are buying it. Obviously, if you were selling just the call, you don't know what your max loss would be, because the stock again could go to infinity. Excuse me, but because we're buying it, we're only risking the capital that we used to purchase the call, and if you won't get margin called or anything like that. That's again only if you're selling options, if you're short options. So since we're long options, we can know that the money we spent, that 16,000, is it. We will never lose more than that 16,000. The further out you go, as far as time is concerned, so each ticker is a little bit different. Something like Apple or SPY, because those are so popular, you can go out pretty far. And again, I can show you that in a minute. But the further out in time you go, so if you go out to 2021, it'll be so much, and then 2022 you're going to spend more to go out, and then 2023 you're going to spend even more to go out. So the further out you go in time, the more expensive it's going to be. The deeper in the money, which correlates to the higher delta you go, again, the more expensive, because there's more likelihood that that will have value at the time expiration comes. So here's a quick example I did the other day. So this isn't 100% accurate to today's figures, but it was only a week or two ago that I created this slide. So an example here is SPY is at 340 at the time I wrote that, and you might want to get the January 22nd, 2022, I'll get it one of these times, 275 calls, and that's about 7,700. I'm wrong. I actually did do this slide today, these numbers. I went back and fixed it. Anyway, so if I did this option, I would spend about $8,000 and I would get 275, and SPY is currently trading at 340. So right there, I know that SPY would have to go quite a bit down. Now we did see, close to this or this during COVID, but that was also a huge event. So chances are between now and January 2022, fingers crossed, that we won't see that number again. So it's fairly safe, pending some economic huge meltdown kind of thing. At that point, we're controlling, because we have around an 80 delta, you're controlling approximately 80% of what you would if you were to buy 100 shares. So you can say this another way. It's similar to having 80 shares instead of 100 shares. So if SPY goes up by $1, you would expect that to net you $100 if you were if you were long 100 shares. Obviously, you have 100 shares, stock goes up $1, you have $100 more than you had before. But because we're at the 80 delta, we're basically controlling 80% of that. So we're only going to get around an increase of $80. Typically, by doing leaps and compared to the cost of long stock, you can save at least half. It's obviously depends on the ticker and how far you go out and what strikes you choose, all of these variables. But you can typically save at least half of the cost by going and doing a leap, as opposed to buying 100 of the stock outright. And in this example, buying 100 340s would be 34,000. And because this is only 7 or 8, that's around a quarter of the cost. So from that perspective, it makes it very attractive that you can benefit from 80% of the move in SPY for 1/4 of the cost. I hope that made sense. Closing, because we're long that call, you have to sell it in order to close the position. You can do that at any time, and so there's no risk in that sense. You're not locked into holding that position. Obviously, you want to wait enough time that you can see a benefit. So, for example, if in the next 2 weeks SPY did go down $10 or $20, you would want to hold on. The whole purpose of getting a leap is to hold on, give you more time to be correct. So you might hold it on for another 2 or 3 months until it came back around and you were able to exit it profitably. So definitely don't panic sell, but you should still close early. I would definitely recommend that. if you get 6 months into the position and you're up by 1,000%, why would you hold on to that position any longer? Because the longer you hold on to it, there's more of a risk of something happening and it going from 1,000% gain to 1,000% loss. So you should obviously close it out when you see some gains. But that's basically it. I guess you should have a exit plan before entering. It's harder to determine what that should be, and even if you create a plan, things change over time. So that's one reason I like selling spreads instead of just doing a long option like this, because with a sold spread, I have my maximum profit potential, and I can just cut that in half and say that's the number I'm going to close it at. But with this, you need to say, well, how well is the economy doing? How well is the stock market doing? How well are the future prospects? Is a presidential election going to affect this? Is something else going to come up that's going to affect this? There's so many more variables in my head that I don't know. Maybe originally I'm going to shoot for 1,000% maybe, but as time goes on, I might scale that back to 500, and then I scale back again to 100 because it's looking more and more like I can't make as much as I originally had hoped. So that's just a little tangent on, it's obviously definitely good to have an exit plan, but it's harder to do an exit plan when you're long options. It's much easier when you're short, in my opinion. Okay, so the variation here is a poor man's covered call. And so all you're doing there is, now that you've gone out a year, 2 years, whatever, and you bought a deep in the money call, now you can sell something that's at the money or out of the money. You can sell a call with that, and instead of the collateral being 100 shares or being money in your account, cash in your account, your collateral is then this leap, okay? And so that's what would get called away, or what you would exercise if things went against you. So the reason people do poor man's covered calls is, again, it's cheaper than owning outright the stock. So you can say you love covered calls because you didn't watch my previous video on why I hate covered calls, and you should too. But say you love covered calls, but you don't have enough capital to do it, and the only money you have is to get some junky $5 stock. Instead of doing that, consider doing a poor man's covered call on a better stock. And all you're basically doing, these are all synonyms for one another. All it is a debit call spread or a vertical. Again, with the terminology, so you're forming a debit spread, and so that will reduce the call spaces of your leap over time, assuming you're correct, and your contract that you now sold doesn't get exercised or become in the money. So I can do a video on that if people are really interested, but it's really just a mashup of leaps and covered calls, and instead of owning the 100 shares, you just have a leap contract instead. And the idea there is to reduce the cost of that leap and potentially make money. Because it's a debit spread, you're still looking for the stock to go up, so it doesn't change your direction assumptions. You're still bullish on the stock, but you're just saying, you're sort of capping it off where you think it will go. So I think SPY is going to go to 500 in the next 2 years, but in this next expiration, in the next 45 days, I don't think it's going to go above 450. So then you can sell a call at 450 or 460 or whatever, and with the expectation that it's going to stay below that you'll collect that premium, then it will expire worthless, and you'll be able to keep all of that premium and take that premium that you collected and subtract that from the cost of the leap that you bought. And then you can continue on doing that cycle just as you would with long stock and a covered call to keep decreasing the value. So again, this is nothing crazy. It's been around forever. And it really is just a wide debit call spread. Okay, so what are the risks associated with all of this, leaps in general and poor man's covered calls? Well, just with the leap, you can't get assigned because you're long, so that's great. Theta will eat away at your position every single day that passes. Since it's so far out, it's a very, very small amount, and that's one thing that I actually like about it, at least typically for my short spreads that I'm doing, short puts spreads or short call spreads, either way. I want to do that around 45 days so I can really utilize theta on my side, because that's when it really, really becomes exponential and chips away at the value of the contracts that I sold to somebody else. So that other person, because it's under 45 days, they're starting off on a bad foot. Things need to move, and they need to move quick, otherwise I'm making money. But with leaps, because it's so far out and it's not getting to that increasing rate of decay, theta decay, you don't really need to worry about that until it gets close to your time. So what I would recommend there to counteract theta is, again, you can do the poor man's covered call, but more importantly, close your leap contract when it gets within, I would say, at least 90 days. So if you're 90 days away and you still have your leap contract, close it and then open something, another leap contract further away. Since you're long that call, that leap contract, volatility, or vega, is going to benefit you if it goes up. So ideally you would buy these in a low volatile environment, aka not right now. And once volatility increases over time, you could sell that, and all else being equal, say you bought in SPY and SPY price hadn't moved at all, and the only thing that changed was volatility, and it went up, so IB went up, then you could sell for a higher value than what you paid for it just based on Vega. So that is definitely a benefit of being long an option. So when it makes sense. Obviously, we discussed before, it makes sense when it's part of the poor man's covered call. And it's much, much better than doing, like I was talking about gamblers getting this week's expiration or next week's expiration. I very, very rarely do that. My shortest I'll do is 2 to 3 weeks out. Most likely it's 3 to 4 weeks out. And those are ones that I'm day trading. Because I want to make sure I have way more time than what I'm envisioning being in that trade. If it's something that I want to swing trade, as in a couple days, maybe a week, maybe 2 to 3 weeks, then I don't do anything less than 90 days. And then I don't do leaps very, very frequently, but the next bullet point is, on a market crash is the best time to get leaps. On one hand, the higher IV stinks and you will lose some money because you're buying those and going from a high IV to a low IV. But the reason I do it then is because that IV will be more than made up for, compensated for by the increase in price. So as the market was going down, I bought SPY calls for September, December, and March of 2021. And I did those in February and March of 2020, this year, with the expectation that by September, the market would have recovered enough, and I want to allow, that was about 6-7 months away at that point in time when I did that. My thought was that we would have treatments by then, they would have all the chaos in the hospitals sorted out. Even if it was still a big issue, we would sort of have our bearings by that point. And even if my September ones didn't pan out, then I have December ones and I have March ones, and none of those were very expensive. So my example there before was paying $7,000 to enter in that position. I didn't do that at all. These were all I think I spent between $60 and $200 per call. And then again, I varied those out, varied expirations, and they were all around the strikes that we had already seen. So they were all around 340 or below. There might have been 1 or 2 that were above that. But the concept there that we would regain what we had already seen, it's dangerous for me to have if I would have chosen higher strikes that we hadn't seen, because there's many more resistant points between where we're at now and then, and we're seeing that now as stocks are sort of leveling out and deciding how much higher they want to go. But at that point in time, when a market is crashing, choosing strikes that the market's seen before will have much less resistance than higher than that. So anyway, that's a bit of a tangent. But that's basically the only time I do it. In video 35, I talked about building stock positions because I don't want access to too much of my money. If I have an account sitting there and everything is liquid, I'm more inclined to open up positions that I'm doing because I'm bored or I think I see an opportunity. So for me, it's better to put that money into stocks, and then I'm much less tempted to buy, to open up new positions. Well, an alternative to buying those stocks would just be to throw it in some leaps. Say I personally hate owning equities. So if you're like me, but even worse, and you just can't bring yourself to own it because of how inefficient it is use of capital, then you can throw that money into some leaps, and that will eat up a lot of money in your account pretty quickly. Again, if you buy 10 of those contracts that were $7,000, that's $70,000 right off your account that you no longer have access to, and it's only 10 contracts. So that's an idea of when it makes sense. If you want to be long stock but you can't afford it, so obviously this applies to a lot of new traders. They really love maybe AMD or NVIDIA or something like that, which is common stock for new people, and they say, well, I want to own 100 shares, but you can't quite do that. So what's the next best thing? Well, it's owning 80% of those 100 shares, and for a half or a quarter of the cost or something like that. So then it's a win-win. I would say if the next thing is if 90 days isn't enough, typically, going back to what I said before, for the most part, I don't do things less than 90 days, especially if I'm swing trading those options. But maybe for whatever reason, you're not comfortable with that short period of time. So then you're going out to something longer, 6 months or a year. So, an example here is January of 21 or January of 22. And you really need to consider the difference there. So just looking at the cost difference, there was only a $300 or $400 cost difference between January of 2021 and January of 2022. And so from my perspective, if you're long-term bullish in the market, going out another year to January 2022 for only $300 more bucks is like, well, to me, that's a no-brainer. The flip side of that, obviously, there's a give and take with everything. Say this over and over again. Those options won't move as fast. So the sub-bullet point there is, because it's so far away from expiration, a move in the market will be much more muted on the further expiration options. Okay, so if you want to get in and get out, then yes, choose the January of 2021. But if you're thinking, no, I really am long-term bullish and I'm scared to death of what the next 6 months could look like, but I think that we will be where we're at now or above after that, then yeah, the 2022 makes perfect sense. You're probably interested in leaps because you got burned too many times on quick expirations, as you should be. And it's not necessarily because you're bad timing or at options in general. It's just the wrong strategy. So people, it's kind of the pendulum swing. They'll go from doing next week's expiration or even this week's expiration, and then they want to go the whole way to leaps. And from my perspective, leaps are better than doing next week's expiration, 100%. So, if you're just starting out, don't do this week's or next week's expiration. If you insist on being long calls. Again, I think there are better strategies. Watch my other videos and my 2 to 10K challenge. But if you insist on being long options, doing leaps is much better. But I think to go from such a short expiration to such a long expiration is a bit too far. Stick with the 90 days. That will give you plenty of time to be correct. Once you get something like 45 down to 45 days, so you've had the option open for 45 days, and 45 days, you opened it 90 days to expiration, and then 45 days passed. So now there's 45 days left to expiration. That's a good time to close. That's when theta really starts kicking in, and that's when I'm targeting to sell my short options. So if you get out before I try to get in, then you're doing fine. Okay, so why I hate them, you probably can guess from all my other points I've talked about, but because they are leveraged, if the market is down and you need to get out, you will have lost more than just holding the stock. So think about that for a second. If I have 100 shares of Apple and the stock market goes down 10%, I will have lost, say Apple went down 10%. Stick with me here. I will have lost 10% on that stock, right? But what's going to happen to options? They're leveraged. And so that 10% drop basically made those options completely worthless. So that is one reason why I hate them. If I'm trying to park my money somewhere to make it inaccessible, that's why I prefer the ETFs over leaps. But again, the flip side of that is I'm not going to make as much money off of leaps, but that's not my objective. My objective is to take it out of my hands, park it somewhere safe-ish that still will grow a little bit, but I'm not trying to make a killing off of it. So that's the first reason. Unlike stock, there is an expiration. So if things do go bad, and say you even chose something 2 years out, and everything is groovy for the next year and a half, and you don't close it, maybe things were trading sideways, or maybe volatility got sucked out, so you're actually down on the position even though your strikes are still good. So things just didn't line up for you to exit out early, or maybe they did and you didn't close out because you were trying to be greedy and get as much as you could. But now you're closer to expiration, and boom, something crazy happens. You just lost everything, right? You had $7,000, and say you had 10 of those contracts. So you had $70,000 all in these long leap options, and now you've got nothing. That would make me sick. I don't want to lose that much money in one position ever. It doesn't matter. I could be, 10 million in my trading account. That still would not sit good with me to lose 70,000. If you have ETFs, like I'm talking about, even if you have to withdraw, again, you're going to lose money, but not as much money. But say you don't need to withdraw. You don't need those funds because you have your emergency fund in cash and whatever other things you have, a full-time job, whatever. That stock can sit there, and it can sit there, and it can sit there, and it can sit there. And 10 years from now, it will have made up any value that it had lost in any downturn. But that option, that 70,000 you lost if you had lead contracts, it's gone. You're not going to get it back. Of course, you can make it up, but you don't want to get into revenge trading, whole nother topic. Anyway, okay. As an income strategy, I feel it's basically the same as long stock. It's too inefficient. Yes, a leap is way more efficient than stock, but that doesn't mean it's the most efficient. And I'm looking for the most efficient, highest ROI that I can. I would rather, some people on the internet want to sell naked puts, and more power to them. But I would rather do put spreads, short put spreads, and only invest 1% of my account in that position than do a naked put, sell that naked put, and have way more collateral associated with that position, and then get margin called because things went against me. I want to know what my risk is getting into the position, and I want it to be as efficient as possible, and all that other money that this other people that are spouting naked puts, all that money that they're using for collateral, I can put into ETFs, which they can grow on their own, and either way, I'm not touching it. And if I choose correctly, I'm either going to break even or get some get some income off of that. So in my opinion, leaps are inefficient because even though it's much less than long stock, it is still much more than a spread or something else. Okay, last bullet point for here. For poor man covered calls. Similar to covered calls. It's inefficient, same point as before. But worst of all, it requires good timing, just like covered calls. It requires good timing. So leap, you have one contract, and so it's pretty easy-ish to say, I think the market, if I'm buying SPY, long call and SPY 2 years away, I'm pretty confident SPY is going to be higher in 2 years than where it's at now. When you're doing covered calls or poor man covered calls, now you need to time your sold leg correctly. You need to make sure that you're choosing the correct strike, and ideally you want to sell that one when it's high IV going to a lower IV. You want to choose the right expiration to leverage theta. And so you're just adding all of this complexity to leaps, which are very similar, pretty pure, easy concept. I definitely believe in keeping it simple. So you're taking something that is relatively simple and you're adding all this complexity to make it a poor man's covered call. So yes, it can be profitable, but let me first state I have not done a poor man's covered call, and the reason I haven't is because every time I do the math on it, it doesn't work out for me. I can't see how people are making money on them when you include life, the variables in the market. So even if you can calculate just raw numbers, a profit, can you consistently collect that premium today that you're pricing it out over the next year? And a lot of times you can't. So you'll have to switch your strikes in order to get that same kind of premium, and then you're running your risk of your needing to exercise your long call, your lead contract. So I'm not a fan of covered calls. Again, see my previous video, and I feel the same thing about poor man's covered calls. I think it's very, very easy, more easy than people like the concept. It sounds great on paper, but I think in practice, if you talk to 9 out of 10 people, it's probably it's more similar to day trading, where there are more people not making money than what there are. Okay, so in the end, what are my recommendations if you want to do a leap? Definitely choose a stock you like, obviously, and that you're bullish on. They definitely have to have a clear trend in my head. I'm not looking for something that I think is going to start trending up, because what you think and what happens are two different things. I liked to pick on AMD for the longest time. They could not get above $50, and everybody was always betting on them getting over $50. It took them years, and they only just did it. So I guess my point there is, if you have a stock that's trading sideways, that's okay, but why not choose a better stock that has a clear uptrend to bet your money on, especially when you're dumping $5,000 into it. So I personally would like to see a clear uptrend, not rather than betting on something that is downtrend or flat sideways action with the anticipation of it going up. I want an uptrend before I get into it. That's just me. If I'm getting into it right now, I'm getting into something that's already in 2022. Or at least at the very end, third quarter, something like that, of 21. But again, that's what I would call a leap. Otherwise, I'm going to 90 days from today. But again, if you're bullish enough to want to own the stock, in my head, going at the money or even out of the money makes those much, much cheaper to buy. So instead of going something like 80 delta, I'll show you in a second, maybe where what I would think would make more sense, and it's then much more cheaper to get into. Those actually give a better ROI because you get a better effect of the Greeks. They're going to move much quicker at the money, and so you'll get a nice boost of of value, especially if you're choosing something that's out of the money and then goes into the money. Definitely stick with calls. You could technically, obviously, do a long put, 2 years from now, if you're really bearish on a stock, which I am on oil, and I've considered doing it. But at the end of the day, I like to play positive, and so I recommend just doing calls. Something might happen, and certainly not a reverse split or anything like that. Those would all be accounted for in your long calls or long puts. But yeah, maybe the company comes in. You have a company like Ford or GM or something like that, who's sort of been trailing off year after year. Maybe they get in a new CEO, totally shakes things up, and then you basically lose your whole contract's value. So my perspective is I like to be positive, so I like to stick with calls, but you do you. Okay, so the final conclusion is there is a place for leaps. In my head, you should get proficient at using options as an income. Then you want to start mitigating your risk by using varied expirations. You want to build a portfolio of at least 25% of your account in ETFs, something that you hands off. You just take some of your proceeds from your options income and dump into ETFs. Then as some hedges, you want to get into long VIX calls. Leaps and VIX makes a whole lot of sense if you're worried about an uptake in volatility. Then you benefit two ways, because the long call itself benefits in volatility and VIX will go up in an increase in volatility. You can look at some other hedges like in TLT, gold or silver, some of the metals. Once you've done all of these things and more, then is when you start considering leaps. And again, probably my favorite time is in a market crash. So that would be top on the list, which I don't have. But yeah, once you've done in a normal regular trading environment, once you've done all of these things, then you can start throwing some money into leaps if you don't want to allocate any more to your income strategy. So that's really all I have. I'll go over to Tastyworks and show you. So the one thing I want to show was the number of expirations. And so right now, you go the whole way out to the end of 22 in SPY. And so that's almost 900 days away. And that varies, and it's certainly going to be 100% different for each ticker that you go into. So let's go to Apple. Okay, September 22. So that's not too different. But what if we went to like Lowe's? Oh wow, yeah. So January 22. So we keep coming in and in and in. So it really just depends on the ticker you're looking at and what expirations they have built. This should be the same no matter what platform you're on. These are not defined by the platform. Okay, so let's go back to SPY, and I'll show you what I'm talking about with deltas. So obviously you can click up here and change it to delta right here, which I already have. And then typically if I'm at the money, which we can see right here is at the split. Right now SPY is about 340. And typically if you're buying a call and you're looking for SPY to go up or something, you might buy this 345 with the expectation that it comes up here, and you would do that as a day trade or something like that. And so to do the leap, you would scroll the whole way up here and get the 80 delta. And what I'm saying is this one is 7,000. So if we go back here and let's say I am bullish and I really think that by the end of 2022, sorry, I'm in a standard deviation. There we go. That we should at least be able to hit 400. So instead of doing the 80 delta, which for this expiration is 8,500. Now if we change that to 400, look at that. It's only 1,500. So an eighth of the cost, obviously not, a quarter of the cost, something like that. Even still, and then as it's coming up, as SPY is coming up here, this is really, really going to gain in value quickly. And you can sort of get a rough guesstimate of what that would be worth by looking at the money. So that's 1,500 and it's 4,000 right there. So if no days were to pass, again, all things else being equal, and it became at the money, it would be worth around $4,000. The downside of this, obviously, is that you run the risk of it never getting there. And so then you've totally lost that money. Whereas choosing something at the 80 delta, the odds of it being 270 in 900 days is above 270 is pretty good. So you at least walk away with something. It might not be at 400, it might not be at 340, but maybe we do end up at 300. Well, you're still going to walk away with some money, and so you didn't lose everything. So that's the reason people are going here. But I personally would rather gamble in this sense and only spend $1,500 and hope that it comes to there. And that's what I'm doing when I did the leaps. So yeah, I went out 6 months and said, well, we had been up to 330 before, so I bought a couple 330s, a couple 320s, 315s, stuff like that. Okay, so let's go back to the slideshow. I have broker links in the description. Comment, share, like, all those things if you could. That obviously helps the channel out. My website's Stacy Tracker. It's free to join, no credit card or anything like that. You can track your trades, your stocks and options, and I'm always adding new features, bug fixes, etc. And we have community members sharing their trades all the time, including myself. All my small account challenge trades are there immediately, and you can pay a fee if you're interested in my pro alerts, which is just all my trades. If you are interested in something like that. If not, again, you can just be a free member, no big deal. Yeah, so this is just for educational purposes. It's all just my opinion, and so take my opinion, watch 10 other people's videos, and see what they say, and then make a decision on your own, and hopefully then you'll be able to form your own trading strategy. Anyway, that's it. So thanks you, everyone, and again, leave a comment below if you need to, and talk to you next time.